Hello everybody, and welcome to our video discussing an overview of the basic and expanded accounting equations. This is a very important concept for understanding double entry accounting and really getting into journal entries and financial statements. You really must understand the accounting equation. So we're going to dig deeply into that and talk about it. The accounting equation itself states that assets must always equal the combination of liabilities plus equity. So assets equals liabilities plus equity. This absolutely must always remain in balance, both for beginning balances, any changes you make, and of course the ending balance. So let's talk a bit about this accounting equation. We're basically saying that the resources that the company has, the assets, must be equal to those parties that have claims to those resources. Now, the first claim is for creditors that have lent money to the company. So the company owes the creditors money. That's the form of a liability. That's the very first claim against resources. The residual claim, what's left, is equity. Owner's equity, stockholders' equity. Basically, that means after the creditors are paid off, whatever assets remain are owned by the owners. They're left to the owners. That's the equity. Sometimes the equity is also referred to as net assets for that reason. It's assets that are left over after subtracting out liabilities. Another way to think of this accounting equation is that the resources that we have must have been financed by something. So we'll add them, or we'll compare them to the methods of financing for those resources. We either borrowed money or we had owners invest money. So those are two different ways of thinking of the accounting equation, but regardless of how you think about it, you absolutely have to follow it. This is one of those rules in accounting that has zero exceptions to it. Now, the good news is, since it's a pretty simple equation, we can use just a little bit of very basic math and restate that equation. So the first equation, of course, is assets equals liabilities plus equity. But if we're trying to find equity, we can just take assets minus liabilities. That does the same thing that we did up here. We're just solving for a different one of those numbers. Liabilities, we can say assets minus equity. Basically, these three equations are all the same equation. It's just a different number of the three you're looking for. We do have a separate video going through what we call a number puzzle with these equations. You're missing certain things. You're trying to solve for other things. That's basically what we're doing here. The key thing is we must always know two of those items to determine the third. Now, again, that number puzzle video goes into various things, like maybe we know the change and we know one of the three balances, but we don't know any of the other items. So it's an interesting video to go through. You'll see some exercises like that. But as I've alluded to, the equation also works on changes. So if the assets increased by 1,000, then either the liabilities or the equity, or possibly a combination of both, must also increase by $1,000. Now, that could be simple. Again, assets increased by 1,000 and liabilities increased by 1,000. That would work. Assets increased by 1,000, equity increases by 1,000. That's nice and simple. But let's say, we know our assets increased by 1,000. Let's say the liabilities increased by 3,000. We're way out of balance there. So to get that far right side, or the right side of the equation, back into balance, we know that equity had to decrease by 2,000. So then the liabilities and equity combination are just a $1,000 net increase, which balances out to the asset increase of $1,000. So that's an important thing to understand. That happens quite often. Now let's expand that accounting equation a bit. We know we could have several types of assets, several types of liabilities, but when we start talking about equity, we start talking more about components or categories. With owner's equity, our two main categories are contributed capital, also known as paid-in capital, common stock, a lot of different terms for it. And then we have retained earnings, which is also known as earned capital. Now, we're talking the ending balance here. and I want to stress that for a reason. But owner's equity, we have paid in capital or earned capital. Now, to get the retained earnings ending balance, you take the beginning retained earnings, which was last period's ending balance. You add in your net income, which is revenues minus expenses, and you subtract out your dividends for the period. That'll get you the ending balance of retained earnings. Now, what you'll notice here, some of these categories are highlighted in red because these are basically your main account types, your main account categories. And we'll see that in later videos, why that's important when we start talking about normal balances and things like that. But again, the accounting equation, we know it must always remain in balance. I've said that multiple times. This is the underlying requirement for what's known as double entry accounting. Double entry accounting, the name tells us that every transaction has to have at least two accounts impacted, two entries, if you will. Now, the thing is, in some cases, both of these could be on the same side of the equation. We might have one asset increasing, another asset decreasing by the same amount. We don't have to have anything on the liability and equity side in that case. They might be on separate sides of the accounting equation. Maybe both are increasing, so assets are increasing, equity's increasing. They might both decrease. Assets decreasing, equity's decreasing. Again, they have to balance out, so the two sides, when you take each side separately, they have to both go the same way and the same amount. The other thing about, we talk about double entry accounting, but it's not limited to two accounts. I said at least two. You might actually have 3 or 4 or 5 accounts impacted. The quantity of the accounts is not the issue. It's the total dollar amount that must balance out. So let's say you have 2 different assets that are in total increasing by $10,000, and then you have a liability increasing by $10,000. You had 3 accounts impacted, but we're still in balance. The 2 assets or 3 assets or 4 assets, however many it was a total of $1,000. That balances to the $1,000 increase on the liability side. So we're good to go there. Now what we're going to do is run through some examples here, and I've restated the accounting equation up here. So we increase the asset 1 by $500, decrease asset 2 by $500. Maybe it's cash and accounts receivable. Whatever the case is, the point is it's a net zero effect to assets, so we would not expect anything on the liability and equity side there. Maybe we increase by $750 for the asset, increase the liability for $750. We borrowed money to buy an asset. Maybe we increase revenue by $1,000 and decrease the liability by $1,000. So nothing has to happen on the asset side because the equity and liability side is a net zero impact. Maybe we increase the asset by $5,000, increase the liability by $2,500, and increase the equity by $2,500. So we borrowed money and we had an owner investment and we got cash out of it. That could happen there. You have 3 things going on, but the assets are increasing by $5,000 on the left side, and then on the right side we have a total increase of $5,000 as well. Now here, you might see, these are the more complicated ones when we start talking about expenses and dividends. We might decrease an asset on the left-hand side by $800. So we know the right-hand side has to increase or has to decrease by $800 as well. But let's say we're doing this with an expense. We have a new expense that we've recorded. So we're technically increasing the expense itself by $800. And if you just looked at that, it looks like we're out of balance. One decreased, the other side increased. But with expenses, when you increase those, that decreases net income, which decreases retained earnings, which decreases equity. So an increase to an expense decreases equity, which balances out with the decrease in the asset by $800. So expenses are always reflected as a negative amount. The same thing happens with equity or with dividend. The only difference is it doesn't impact net income. It goes straight to retained earnings. So an increased dividend, meaning we've recorded more dividends, That decreases retained earnings and decreases equity overall to offset the decrease in the asset side. So this one's the one that causes people the most trouble. Let's go back and talk about the account classifications that we just mentioned earlier, the ones that were highlighted in red. We have assets, liabilities, paid-in capital or contributed capital or common stock, whatever term you want to give it, revenues, expenses, and dividends. Those are our 6 account classifications that become very important later on when you start learning normal balances and journal entries and things like that. The one thing I want to point out here, first of all, there are other account classifications. These are the core ones. There are others that relate to these. We'll talk about those in later videos. The other thing I want to mention here is that it looks like we left out retained earnings at first glance, but retained earnings is really a combination of the other accounts. The same could be said about net income. Net income is more of a subtotal than an account. Retained earnings is technically an account, but it's a combination of other accounts. Revenues minus expenses minus dividends. It's another level of equity, the earned capital, right alongside a paid-in capital. And technically speaking, when we get to normal balances, we'll find out it should have the same normal balance of like a revenue or a paid-in capital, assuming it's positive, it's been increased. But again, that's for another video. So let's talk about these account classifications here. We have assets that are the resources owned by the company. We have a variety of examples: cash, accounts receivables, supplies. Notice here, by the way, supplies. This is the supplies asset. It's just called supplies. There's another account that's an expense called supplies expense. 2 separate accounts that they work together, but supplies is an asset. Inventory. These are the products and goods that the company has bought that they're going to sell. Office equipment, the equipment they're going to use. Again, these are resources owned by the company that they're going to be using for one purpose or another. Liabilities, the easiest way to describe these is these are the amounts owed by the company. A lot of times you'll see the word payable at the end of the liability. Accounts payable, notes payable, salaries payable, but there are some that don't have payable after them. Unearned revenue is one we'll talk about in the adjusting entries video in a later time. But these are all liabilities. We owe something to some party. Revenues. Now, strictly speaking, I want to talk about revenues. These tend to be good things. You think of them as good things. These are the amounts that are earned by the company in their normal business operations. That's the important thing to note here. This is what they're in the business of doing. They're selling products, they're providing services and earning the money. There's another very closely related topic called a gain, which is a good thing. Gains are good. They both impact net income. They're both positive. The difference is a gain is something that's not really what they're in the business of doing. It's just a transaction they happen to have had. It's a peripheral transaction as opposed to one of their core business operations. They had some equipment they've been using for years and they decided to sell it and they happened to record a gain. Yes, that's a good thing, but it's not a revenue. It's just slightly different. Now let's move on to expenses. And the first thing I'll mention is we have the same basic thing going on there with losses. Losses are related to expenses in the same way that gains are related to revenues. They're in the same direction. They're negative, but losses are not core operations. They're not core business operations. They're peripheral transactions. Losses are the opposite of gains. So expenses, the true expense, is an amount incurred by the company in order to generate revenue throughout its normal business operations. In other words, if the company wants to run and operate, they know they're just going to have to pay certain bills. You have to have employees, so you have salaries expense. You have to have utilities, you have rent expense. Depreciation expense is one we'll talk more about later. It's basically the usage of equipment or buildings, long-term assets. And then cost of goods sold. Notice this one does not have the word expense after it, although it's a very important expense for a company. It's basically the expense of them using up their inventory to sell it. So the point here is that the only reason we have these expenses is that we're trying to run a company and generate revenues. When we get to paid in capital or contributed capital, these are the amounts paid into the company by the investors or owners. The key thing is this is not debt. The company does not have to pay this back at a certain time. It's an owner investment in order to participate in the returns of the company, but both risks and losses, risks and rewards. So again, paid in capital or contributed capital is not debt. This is basically, for a corporation, it would be stock. Now, the investors do expect an eventual return on that investment. Sometimes it comes through the form of a dividend. Sometimes it comes just later on when they sell their stock. It's worth more than it was when they bought it, but that's paid in capital. Dividends are amounts that are paid back to investors as a return on their investment. Now, this is such an important thing. On my very first week of accounting, it was something that threw me off a little bit years ago. But dividends are not an expense. They act somewhat similar to them. They're both negative, but they are not an expense. They do not even impact net income whatsoever. A dividend directly impacts retained earnings. That's the important thing here. So dividends are basically distributed earnings as opposed to retained earnings that we'll talk about now. The company retains the earnings, and it's all the net income the company has throughout its life. But then at some point they might decide to distribute that out to the owners who really have ultimate claim to it. But the board has the choice of, do they want to hold on to those earnings now to finance the company for the future, or is it time to just pay them out? So a dividend is a payout of those earnings. Now, retained earnings, which is also known as earned capital, again, these are the amounts of the net income throughout the company's life that they've decided to retain for future growth or investment, that they've not yet paid back to investors as a dividend. Some companies never pay dividends. The money just stays in the company. The company's value continues to grow, hopefully their stock value as well. And then whenever the investor does decide to sell, they have a large, maybe a gain on that investment. That would be their return. Of course, it could go the other way. It could be a loss, but obviously the company or the investors want a return, a positive return. So that takes us through the account classifications and how they relate to the accounting equation. We're going to talk about normal balances and journal entries in later videos, but hopefully this has helped to clarify for now. Just another reminder slide talking about where you can find other videos that I've created on topics. You can go to my YouTube channel, you can search Google, or I've also included a link to this list of videos in an Excel spreadsheet format. The list will be in the profile of this video. So thank you again for your time. I hope this has helped to clarify the topics. Have a great day.